To today's session, we have Gaurav, who is a global tech investor and advisor. He's previously managed funds for family offices and VCs, executed IPOs and investment banking deals worth over 2 billion US dollars, and worked in technology consulting. He's also the founder of AMG Venture Partners. He assists founders with their fundraising preparation, everything end to end, and helps them raise capital from angel investors, VC funds, and family offices. Gaurav is an engineer in electronic and telecommunication, has an MBA in finance, and holds a certificate in AI from Kellogg. Thank you so much for joining us, Gaurav. We're super excited for today's session, and I'll hand it over to you.
We're going to discuss the topic how to prepare to raise capital from angels and VCs, right? So there are lots of preparation required before you even talk to investors, right? It's similar to when you, let's say, apply for your master's or undergrad, you prepare your application before the actual interview, right? So it's a similar process. So I will declutter the entire process for you. Okay, let me share my screen. Perfect. Let's get going. So Gurmer already did an amazing job. I will quickly just summarize that I bring in a mix of tech and finance backgrounds, having worked in tech consulting, investment banking, and venture capital. So I've managed around 35 VC investments in 10 countries, closed USD 2 billion worth of IPO deals. I've done term sheets in 10 jurisdictions for startups, invested in tons of companies myself, and I've reviewed 20,000 plus decks and models in my career. With that intent, I founded AMG Venture Partners, and I work across sectors. So currently, what I do is I run investment readiness programs where I coach founders on how to raise capital from angels and VCs globally. I also take fundraising mandates. I build compelling stories and narratives and prepare you how to present. And I also build very detailed investor-ready financial models as well. At the moment, I work in 4 countries across 10 plus ecosystems. White space is here as well. So excited to be working in so many ecosystems as a mentor. These are some of the ecosystems that you can see. And investment readiness or getting prepared, it's not like a theory, it's not a course, it's a step-by-step customized execution roadmap for any founder planning to raise equity capital in the next 12 to 14 months or currently raising. And it includes 6 group sessions of 2 hours each, and then 1:1 parallel customized support, right? So of course, we can't do everything today. Today, I'm gonna teach you on what goes into the entire preparation to raise capital, right? What are the 6 things you need to worry about in terms of your investor kit, valuation, funding ask, runway, cap table, financial modeling, pitch decks, finding investors and negotiating terms and answering investor questions, term sheets, what terms not to agree on, how do safe agreements of convertible notes work, and then 1:1 prep, right? So we'll be talking about all the steps that you at least need to know and work on before you pitch to investors to raise capital. Okay, so that's what we're going to cover today. We're going to understand how angels and VCs operate. How do you evaluate if your angel or VC fundable or not in the first place? How do you decide what type of investor to reach out to? How do you plan your fundraising process in terms of timelines and materials and execution steps? And what goes into your material or the investor kit? So everything you need before you reach out to investors. All right, let's get to it. The first one, understanding the investor mindset. You need to understand the numbers behind the investor mindset first, okay? Because in market, you will hear a lot of terms. An investor expects from a founder a 3x return, a 10x return, a 50x return, a 100x return. All numbers are thrown in the market. I want to declutter the whole process for you, okay? Now think of it this way. Oops, sorry. Think of it this way. I am a fund manager. I am managing funds of $100 million for some other investor. These other investors are called limited partners or LPs. When they give me 100 million to invest in startups, they expect that I give them a 3x return in 7 to 10 years. Okay, now let's look at this statement with this mathematics here. Very simple. If I invest $1 for a period of 10 years, which is this 10 years, and the LPs expect to get 12% return per annum, it calculates to $3.1 over a period of 10 years. What it implies, if an investor gives me 100 million to invest, they're expecting a 3x return over the next 7 to 10 years, which implies a 12% annual return. So that's the minimum return they expect from me. So that's the takeaway from you for you, that when somebody says 3x at a seed or pre-seed stage, that is the return the limited partner is expecting from me as a fund manager, not from you as a founder. Okay. So that's the first step to understand. Now, let's say I got this 100 million money to invest. 20 million goes for operational costs over 10 years. So I have 80 million to invest. This is very important. You will realize how this plays into your business projections. Let's say I invest 1 million in 80 startups, right? So 1 million each. This is the actual return profile of how it happens in the market. So I invested 70 million by investing 1 million in 70 startups, and 70 of them gave me zero return. So my entire 70 million, I received nothing. I invested 5 million and I got 1x return. So I got 5 million back. Going with this table, only one startup gave me a 50x return. So when I invested 1 million in that startup, I got 50 million back. And one startup gave me 100 million. I add all of this, I got 185 million back at the end of 7 to 10 years from the founders. Was that what the LP expected from me? No. LP wanted 300 million. That's 3x. But I just got 185. Why? Because the data shows that more than 90% of startups that we invest in, they fail for lots and lots of reasons. Hence, keeping that probability in mind, we as fund managers, we are expecting that any startup or any founder we invest in at a pre-seed seed stage should give us 100x return in the next 7 to 10 years. Okay. So when I look at your business projections, you send me an email, hey Gaurav, I'm raising capital, would you invest? I'm trying to figure out whether this founder and this product or this company will give me 100x return. So if I invest $1 in you, can you give me $100 back by the end of 7 to 10 years? That is what the investor is thinking. And if you translate it into further, it comes as investor is expecting 50 million to 100 million in revenue over the next 7 to 10 years. And there is a mathematics behind it. We'll not go deep into the mathematics today, but the key takeaway for you from this very important slide in understanding the investor mindset is, from you as a founder at a pre-seed and seed stage, for let's say software startups or SaaS startups, I'm expecting 100x or 50x to 100x return in the next 7 to 10 years. That's the key takeaway for you from this slide. Okay. So keeping that in mind, now let's look at, you would have come across a customer sales funnel, right? Or a sales funnel metrics. You have your leads to demos, demos to paid customers, just a small funnel. This is your investor screening funnel. Okay. So imagine I am the investor. 2000 startups send me either an email, a LinkedIn message, or pitch to me at a demo day in a year. Out of those 2,000 startups in a year, my investment rate is 0.5%. So I make investment in only 10 companies. And this is higher. It's generally much lower. What it implies, that I'll probably look at minimum 2,000 companies if I have to make 10 investments in a year. Okay. Why this is important for you to understand? When you send me an email or you send me your deck or you send me a LinkedIn message, you have to be so sharp and crisp and prepared that I will take 2 to 3 minutes to decide whether I want to give you a 1 hour call or not, which is my round one of screening. Okay, please understand this investor funnel. This is the kind of preparation you need to do if you want to raise equity capital. Okay, you have to be so prepared that out of these 2,000 startups sending me their deck, you're able to navigate this stage and get that 60-minute call with the investor. As per DocSend, investors spend 2 minutes approximately per pitch deck. Your job as a founder is to make it count. This triangle here shows you that when you pitch to me as a founder, this is the triangle investment, but that is not the only task I have as a fund manager. I have three other tasks as well, which shows that because I'm so occupied in so many tasks and there is high volume of startups pitching, if you do not stand out, it is very difficult to move further in the process. And that's where founders feel frustrated when they reach out to 200 investors, nobody's putting money in the company, right? That is why it's important to understand this investor screening funnel as well. Now you must be wondering, how do investors evaluate so fast, right? Like, how do I take 2 minutes to evaluate an email or a deck? Because we are looking for fundability signals, right? We are looking at social media consistency. We are looking at your deck or email or message and thinking, would this founder have the capability to give me that 100x return? And we are also checking if there are any red flags in our evaluation process. Okay, so something to keep in mind. And let's go deeper into what am I looking for? Because if you don't understand what an investor is looking for, all the preparation and pitching will go in vain. Okay? So the first thing that I'm looking for is a stellar founding team. Are you the right founding team with domain expertise and complementary skill set? So for example, if you're building, I'm just making it up, you're building an AI company for energy efficient solutions in oil and gas industry, just making it up. Okay, so are you the founders who have worked in oil and gas? Do you understand that industry? Do you have expertise in AI? And third, do you have enterprise sales experience? I'm looking for that in your deck or message or email. Vitamin or painkiller, extremely important. How critical is the pain point that you're addressing? Or is it just something you're building which everybody else has already built before? There is no entry barrier. It's very easy to replicate. Do the customers even need it? Right? Third, how big is the market opportunity? Remember, I'm looking for this 100x return, which translates that are you the company which can build a 50 million to 100 million revenue company in the next 7 to 10 years? Can you do that? For that, you have to be targeting a very large market. These are self-evaluation checks, by the way, which you can do at your end. Fourth, what stage of validation are you? Are you at an idea stage where you have some thought process in a paper, or are you at a traction stage where you have some paid pilots or some kind of partnerships or something to show that there is a need for this product in the market? What signal can you send me on this parameter? Fifth, we check for what's your business model? What's your revenue line? What's your pricing strategy? What's your go-to-market strategy? How will you reach out to customers? Do you have any partnerships? What's the strategy have you put in place or not? We evaluate all of this as well. Then specific to your segment and stage and sector or business model, we look at metrics, right? I've just put in certain standard metrics like unit economics, ARR, annual recurring revenue, lifetime value of a customer, customer acquisition cost, churn, payback period. These could differ with industry and stage, but whatever is relevant to your business, you as founders need to know and articulate it. Okay. Seven, we look for competitive edge. So what is your unique selling proposition? Right? In your deck or message, are you able to articulate something that why do you as a team or product or strategy stand out? Okay? If you say we have no competition, we are the first ones, it implies there is no market. Because there's always some competition out there. Okay? Growth strategy. So amazing. You have a great team. You're solving a great problem. There's a big market. What is your execution plan to achieve that 50 million to 100 million revenue in the next 7 to 10 years? Are you able to articulate how you will build that business? What would be the projection? What would be the product roadmap? What would be the team building plan? Do you have that ready or not? If not, talking to investors is vain because they will ask you for that, right? Then lastly, do you even know how much capital you need? I've come across founders, yeah, we're looking to raise 200K, or maybe we can raise 500K. Then I ask the question, why not raise 2 million or 1 million? So have you even thought about why you need what amount of capital, when should you raise it, how long should that last, and what will you achieve with it? So very, very important part in the numbers game. These two aspects are all numerical aspects in your pitch deck. Okay. Lastly, when you pitch me this, I evaluate at my end whether I will make a return on this investment or not. So these are the signals I'm looking for in that initial deck or email that you send me. And you say, hey, Gaurav, I'm so and so, I'm building this company, I'm looking to raise. Would you like to invest or have a call with me? These are the signals I'm looking for.
Gaurav, I'm just going to interrupt you
Yes,
for a second. We had a question
yes,
about the previous slide saying, what do you mean by social media consistency?
absolutely. We'll be covering that just.
Thank you.
Any other questions?
Just that for now.
Okay, perfect. I'll go back to my screen. All right, let's keep going. So I will be covering that. I'll be covering that here. So I'll come to that. Okay. Now, in terms of growth story, right? When you send me your deck, I have seen sometimes founders send me that by year 5, you're going to have 5 million in revenue, 10 million in revenue. If you show me 10 million revenue in year 5 for a software startup, it means I will never make that return of 100x. Because by that time, I'm expecting you to be on this trajectory, right? So this is one very quick checkpoint when you send a deck to your investors or target investors with a pitch deck. In a software startup, after achieving product market fit, I'm assuming or hoping you would grow at a framework called T to D3, which is triple, triple, double, double, double. I'm expecting you might grow at this rate, which is from 2 million, you grow to 6, 18, 38, 72, and so on. This is the path towards that 100x return. I'm looking for the path and not really the exact number. Okay. Now, if you might say, I'm not a software startup, right? In that case, if you're a deep tech, hardware, medical device, or life science, or even a climate startup, I know you will have zero revenue for the next 4 to 5 years. In that case, I'm not looking for these projections. I'm looking for a stellar team with past exit or domain expertise, any data lake or data strategy or partnerships you have built, and these are signals I'm looking for, by the way. Your technology readiness level, paid pilots or proof of concept, your progress towards Health Canada or US FDA approval, your reimbursement landscape study, any clinical trials, anything which shows progress to some extent. Okay, so these are the signals I'm looking for when you do that initial touch point with. Okay? Now, coming to that, what am I not looking for, or what are some of the red flags, right? First is the corporate structure, right? So often I've seen founders have a parent entity and a subsidiary as well, and you want to raise money in the subsidiary. Investors don't invest that way. They prefer investing in the parent entity. So try avoiding that conflict. Second is part-time founders or founders not owning significant equity. So if you're a part-time founder, it's a big risk for us because you might quit tomorrow, right? And we want 200% focus of the founder on the startup, right? So part-time is not good unless you say, hey, with this funding round, I'll be switching full-time. The other part is at every stage of the startup, let's say pre-seed, seed, Series A, Series B, these are stages of funding or progress. At these stages, we expect founders to own certain equity collectively. Okay, we have those checks at our end. So if you do not, let's say for at a Series A round, after Series A, if founders collectively do not own 40% plus of the company, then it kind of goes into the red flag category, right? So these are some checks you need to be aware of. Third, it's a relationship game, right? 7 to 10 years is a long relationship with exchange of money and shares. So the level of leadership, humility, and team aspect is important. If we sense in your messaging or discussions ever there is overconfidence, ego, arrogance, it means you do not have the right leadership skills to even build a team, so you won't be able to execute. Fourth, if you hide any legal aspects, right? So sometimes there are legal dispute against the founder or the firm. If it is business in general or otherwise also, do not hide. Please disclose it because we will find out. Now, social media inconsistency is when over on the LinkedIn, your profile says you're working in three different companies, right? You are a co-founder of three different companies. Your website doesn't even talk about you, right? And you're not focused on one startup where you want the money, right? So this is social media inconsistency. This is a key check we do. For example, I received a deck. I will go and check the founder's LinkedIn profile or Twitter profile or the website of the company. If they don't match, it's a big red flag for me. It means you don't know what you're doing. It's probably that you're just trying different projects and calling yourself a co-founder. So that's what I mean by social media inconsistency. I hope that answers the question. Uh, the other two key part, what we're not looking for is insignificant return. So I already told about the 50x to 100x return opportunity for each pre-seed seed software startup. Oh, sorry. The other is if it's not, if you're asking for very high valuation means I will get a very low stake. So that's something we don't look at. Uh, if it's a very small market, we don't look at that. If it's a product which can be very easily replicated by anybody, that means it's a low entry barrier. Or if it's not a sustainable business model, like the margins are extremely low and the model can break down super fast, right? So these are some of the things we also look at. The last thing, which is a little subtle but important, is ensure you know where your IP lies. So sometimes, you have two entities in different countries. Your IP is owned by the entity in the different country. So that becomes challenging. Sometimes if you are targeting impact investors, then do you have any environmental aspects associated? Certain investors may not invest in certain sectors, which may be out of their mandate, and also geopolitical aspects, right? So, for example, if you have money from an investor from a certain country, and those countries are at conflict, sometimes that becomes very challenging because the new investor will not invest in that entity, right? So, subtle things to remember. It's like know your investor, where the money is coming from. Okay, so that's about the red flags you need to be careful about if you intend to raise VC money.
I have a few other questions. So another one is, do VCs invest in beverage companies since there isn't really IP?
Yeah, there are B2C or let's say consumer VC investors. They do invest. And in consumer, it's not really about IP, it's more about branding, marketing, distribution channels, ability to build that brand and scale.
Okay, perfect. And how much weight or belief do you put into founder projections?
How much weight and belief? Oh, why? Think of it this way. Whatever product you have to show me the commercialization aspect of it, right? So we put a very strong weight in the rationale behind the numbers and not in how it's presented.
Got
Remember, your PPT and financial model is just a representation. It's just the output. What's more important is why this number and how did you arrive at it,
got
right?
it.
So yes, we
Thank
do
you.
look at numbers and they should align with investor expectations as well.
Understood. And do VCs also invest in service companies, for example, IT services?
Not anymore, at least not that I'm aware of, because the scalability of service companies is proportional to the, let's say, headcount versus software, which is, exponential growth and not directly proportional to headcount, versus the new paradigm which we are seeing in agentic AI, which is you can even make a $1 billion company with 10 employees today.
Got it. Thank you so much. And yeah, I think that's it for the questions in the chat, and we can go back to the presentation.
Okay, perfect. Just want to clarify. So I think what Paul and Sandy were talking about, just for everybody, you can operate a business as something else. That's called a naming convention. That's different. I was not talking about that concept. I was talking about the concept where you own two legal entities, two businesses registered separately, right? And you have a ownership structure between the two businesses. That's what I was talking to about as parent and subsidiary entity, right? Just wanted to clarify that so everybody doesn't get confused. Okay,
Understood. Thank you so much, Gaurav.
of course. Let's get back. All right. So whatever we have learned till now, I've just flipped that into questions under the category called business hygiene. Right? So this is a self-evaluation check that you can do at your end, right? Before even talking to investors. And it's a key check for are you angel slash VC fundable? So we'll not be discussing that. We already did that, but this is just flipping the concepts for you to evaluate yourselves. Similarly, for venture return, are you the company who is on path or sending signals which will be able to build a 50 million to 100 million revenue in next 7 to 10 years? Can you provide me that return? This is counter to the slide that I explained here, right? So before reaching out to investors, you can do a self check on these aspects as well, right? Because whatever you learn, you should be able to apply it to your respective companies, hence these questions as an exercise for you. Uh, okay. All right. So the other key thing for you to remember is because you might be targeting both angels and VCs, they are not equal when it comes to investment approach. Okay. When it comes to business hygiene or venture return or signals, right? Angel is somebody who may have the money but may not be experienced in understanding the hygiene aspects we already discussed. So they may overlook it and probably give you a check. Whereas a VC would definitely check for those. Or let me put it this way, an experienced VC will surely check for those, right? Venture return questions, which I just showed, an angel probably will review few parameters, but he or she may miss out on most of these. And they often end up giving very high valuations, which later can lead to down rounds as well. Okay. Whereas again, a VC will do a thorough evaluation. Now, the best part about angels is they won't necessarily wait for you to have a full-fledged product or for you to have a revenue. Sometimes they understand the space or they face similar pain. They might invest because they're passionate about it. They might even invest prior to any regulatory approvals or even having a commercial grade product prior to any revenue. They may often lead a pre-seed round as well, right? So that's where they're pretty helpful at your stage. Whereas a VC will have probably much more standard checks before they can cut a check. Proper checks, as in the filters, before they cut a check into your company. So the key takeaway here is if you are able to raise money from angel, does not imply that you are VC fundable as well, unless you are checking for all the questions we already discussed. So angel fundable is not equal to VC fundable. Okay, so we have discussed three things by now. Understanding the investor mindset. So we looked at the numerical game. We looked at the questions on business hygiene and venture return and fundability signals. Let's look at the next step in how to prepare to raise capital is on the investor profile. Any questions till now before we move here?
Yes, there are a few
Yeah.
questions. One from the previous one was if prototype funding is available.
Prototype funding. Yes, there are grant programs generally for that, right? So you have grant programs in Canada. You have some platforms also to check for that, depending on which sector are you in. Are you in robotics? Are you in medical device? Are you in electronics? Or are you in a climate hardware startup? Depending on that, also you can target angels. Lots of angels also invest. VCs very rarely invest in prototype funding.
Got it. And what happens when an investor doesn't get the ROI they're looking for, or if the technology that they invest in doesn't work out?
That's okay. That's part of the game, right? That's where I showed the first slide,
Yeah.
which is the mindset, which is we know that 90% of the investments will probably fail because of the unknowns, right? Hence, we assume when we invest that each of the investment should show us 100x potential. So that's the idea. So that's okay. That happens so many times.
Got it. Thank you. It's actually very interesting.
I have
And
a question, please.
Yes, please.
go for it.
Yeah, so I saw the part of the investors funnel. Can you go back to the slide, please? If you,
The
yeah,
investor
so
funnels slide.
yeah, the investor funnel. Uh,
One second. Let me
No,
just go back. This one?
oh, no, I think yeah, the screening funnel. Yeah, so I didn't really get. I think I missed something. Yeah, can you just give overview because if investors before now, you mentioned something that I think I lost you at that point, but I feel this is very important to any founder. And so if you just give a brief,
Sure, I can explain it again, no problem. So
thank
what I was
you.
trying to say is that we typically spend roughly 2 minutes per email, LinkedIn message, or deck that you send us. The objective of the founder is to make it count in such a way that your deck is so sharp and crisp, or your messaging is so sharp and crisp that when you pitch us, this is the stage. This is the first interaction stage, initial screen, right? So assume 2000 companies are pitching to us. We take 2 minutes to decide, or maybe 3 minutes, whether we want to give that 1 hour call to the founder or not. That's round one, right? So generally, very few companies move ahead to this stage. Very few companies. Okay. So and then from here, in that 1 hour call, we do another analysis, we ask questions, and we decide, okay, we want to either pass this company, or we're like, okay, no, we want to have another call. So that's the next 60 minutes. And out of 120 companies move ahead. Then we like this stage of the call. We're like, okay, this is interesting. We want to get into the due diligence stage. So out of 20, maybe 10 companies move into the due diligence stage. And this can take even weeks and months. So I just put hours for you, right? So and out of 10, assuming all 10 get the investment after due diligence, it shows that out of 2000 companies, I invested in 10 companies, which is 0.5% investment rate. Does that help?
Yes, please, got it. Then a follow-up question to that, I think, is on the next slide, where you mentioned that if investors see that nobody has done that before, maybe a red flag that someone must have done something similar, that there's no market for it if nobody has done it before, you don't have competitor, kind of.
Sorry, I couldn't understand the question.
Okay, yeah, I think you mentioned that if they look into the space that your business is, and if investor cannot find any competitor in your space, you are
Okay.
the first person, then that's a red flag. So I'm thinking in between that, okay, because the best product is formed from pain points, right? Yeah. So pain point may be that nobody has done it before or solved that particular problem. So I may be confused between that and your
Yeah.
submission to
So
that.
that is the assumptions that founders have, that they are the only ones doing this because they haven't scanned the global market, right? Most of us have probably looked at the startups in our incubator or in our province or if we are very outgoing, maybe in other provinces or in our country. But as an investor, I'm looking at the global market, right? I'm looking at where I can put my dollar to get the best return. So I'm comparing with things in the US, in Canada, Europe, Asia. What is the product landscape for similar products or business use cases or problem statements that you're solving? So that's what I imply by that you do not have any competition or we are the only ones to do it, can sometimes imply that you're not aware about the market landscape at a global level. Does that help?
Yes, it helps, but another question. I'm sorry if that bothers you, but I didn't know. I mean, for people that have five patents for a particular business or deal, I mean, that means this is my idea. Nobody, if the patent is approved, that means nobody has submitted it before or something, right? So I'm just a bit confused between a new idea and because someone must start something, even if it has been done before. It has, I mean, it was started by someone at some point. And so are there no new ideas or no, are we saying no innovation or no business that can be at this present time that there's no new business that can erupt or founded by someone. It has to be something related to what some other people have done in the past or are doing at the moment.
I'm trying to understand that. So it's not that somebody has to do it. If you can prove to me, hey, listen, Gaurav, I've studied the global markets, right? There is indirect competition in this way, and there is some competition in a service-oriented way, but we are the first ones to crack it using this innovative product that works. But you have to be
And
very, very sure about that.
oh, okay, excellent. I got it now. Thank you.
Of course, yeah, no problem.
Thank you. Thank you, Gara.
Well, all right, does everybody see my screen again?
Yes.
Okay, let's get going. All right. So we'll now talk about what type of investor to target, right? Uh, don't worry about the numbers on this slide, but I use this slide just to reiterate a concept where you would have heard the terms like you're at a beta stage or pre-seed stage. You're at a seed stage or minimum viable product stage. You're at a series A stage or product market fit stage or scaling. These terms mean differently at each for each sector, so they are not tied to this number. But what you want to take away from this is you know what stage you are at with respect to your sector, right? Are you at a pre-seed or seed stage? So keep that in mind and be fair to yourself that okay, if I'm at pre-seed, let me not call myself a seed stage company. Okay, so that's what I want you to keep in mind. What's the stage of your business? That's the first thing you got to figure out. Second, keeping that in mind, look at this chart. Think of it like your x-axis and your y-axis. Okay, now this will give you a very good idea of what type of investor to target. Okay, so let's start here. Let's say you're a founder who's straight out of college, university, or academia, who's never executed or worked in a corporate before, never done that. And so you are in this quadrant or this, let's say, portion of the chart, and you just have an idea. It's not even an MVP, you've just got an idea in the mind. Then where do you go to raise funding? You go in this bucket. You self-fund it, you raise from friends and family, your rich family members, relatives, friends, whosoever. You win some prizes, get some grants, maybe participate in some equity incubators as well because they can give you cash. So this is the investor source you can target. Let's say you are here, you're growing 10% month on month in revenue. That's a very good growth. So now, and you're at this stage, you can now target micro VCs or pre-seed VCs, angel investors, even VC scouts, right? So this will give you a very good self check in an honest way that where do you stand as track record of the founding team. So this is the track record of you and your founders, co-founders. So you hear in the market, right? Oh, this company raised a 20 million seed round at 100 million valuation without revenue. How did that happen? That's this. These are founders who have previously built companies from scratch, given an 8+ figure exits. Now, investors know they have been there, done that. The probability of success of such a team is very high, and I'm relying on that probability game, which I told you in the first slide, right? That's where even if these people have just an idea, I, as a tier one VC, is more likely to fund them. Okay, so this table will give you a very good check of what type of investor to target. So that's the second thing to remember. Third is, of course, you know your stage. You also know sometimes from the investor's website what stages they invest in, what geography they invest in, US versus Canada. Always a big debate. Would they invest in Canada or not? So you should check that. What sector do they invest in? What ticket size do they invest? So typical range. And any other parameters, software, hardware, pre-revenue, post-revenue. This is the first check you need to do. Why? If you don't do this and you reach out to 500 investors, you're wasting your own time, right? They will anyways not respond. So this is important to identify the app target investor for your target list and save on time and efforts. Okay, so as a summary, first we learned understanding the investor mindset. We learned about the 50x to 100x return in 7 to 10 years, 50 million to 100 million revenue expectation in, let's say, 7 to 10 years. Investors spending 2 to 3 minutes on a deck. But remember, this return expectation, it changes with the stage and sector and business model, right? So for a climate startup, it will be different. For a software startup at a Series A stage, it will be different. I'm talking this about pre-seed seed software startup because I'm assuming most of you are at pre-seed seed stage. We also learned about, are you angel VC fundable? We looked at some qualitative and quantitative parameters. We looked at the red flags or the business hygiene aspects. We looked at the venture return or fundable signals. And we also understood that getting money from angels does not imply that we will get money from VCs as well. Okay. And the last point we covered is your ideal investor profile, your stage of business, your founding track record and company's progress, and investor filtering based on those filters. These are the first 3 steps in preparing to raise funds from investors. Raising funds from investors is not about building a PPT and going and meeting investors. No, it's these first 3 steps are critical. Now we are going to get into the fundraising strategy and what materials we need to prepare. Okay, so just revising, we've already done this part. Now let's get into the timeline and investor kit. Trust me, it's a very simple process. There's no rocket science. The problem is we as founders, I'm also a founder like you, we straight want to go and talk to investors. We don't want to put in the effort and research and work to prepare before talking to investors, and that's where things fall off. So the most common questions are, when should I start raising capital? How much capital should I raise? What about my equity? Should I be concerned about dilution? I have 1 million in revenue and I saw that it's 20x multiple in the market. So should my valuation be 20 million? So how do I think about valuation? Right? These are some of the key questions that founders need to address before talking to investors, because they will ask you, how much money are you raising? Right? They will ask you, why are you raising so late? So I've had these scenarios when founders have reached out. We have 4 months of runway or money left in the company. If we don't raise, we will shut down tomorrow. I will never invest in those founders, right? Because you're already too late in the game. Some founders say we are raising 1 million for 12-month runway. That is a big red flag. Most of you may not know it. The reason being, a fundraising process takes 4 to 6 months. If you're raising for only 12-month runway is how long the money will last you. If you're raising for only 12 months, it means every 6 months you're going to be raising capital. That means you have no time to focus on product, sales, and team. Big red. Then sometimes founders send me this email. I'm raising 5 million because they come from some academia background to build a prototype. Unless you fall into this category and you build a prototype means you're at this stage, doesn't work. You have to self-fund yourself or get some grants. You can't reach out to a VC for that, right? So these are, see, some of the mistakes which founders make in their initial outreach, but the mistakes are on the numbers which they don't even realize. They say we have 1 million revenue and I need a 25 million valuation just because they assume that you will get a multiple of 25 on this revenue. Big mistakes. So these are the things founders need to first understand before talking about these things. Okay, and we'll try to cover a few of these things today. First is planning your timeline, right? So we did the fundability score check, which we did in the first session. We talked about the ideal investor profile. So from this, you make your target investor list. And then you prepare your materials. I'm going to show you what are the materials you're going to prepare. This whole preparation takes at least 2 months in my experience. And I've worked with a lot of founders in this space. Unless you're a founder who've been there, done that before, you're an exit founder, that's a different story. Most founders are doing this for the first time or raising for the first time from professional VCs. Then it will take you at least 2 months to prepare. Founders don't do this and they jump straight here. They just want to do the investor outreach. They want to reach out to 200 investors. They got some nice, list from LinkedIn. Somebody said, hey, I have 100 investor list, comment, like my post, give me visibility. I'm going to send this to you. Founders become super happy, download and send emails. Doesn't work. Without this prep, it just doesn't work. Okay. But let's say you do put in this effort, then the next logical step is the investor outreach. Then by month 1, 2, 3, 4, you start the outreach and you start having meetings, you enter due diligence and you close the round. So typical process takes 4 to 6 months if you have put in the effort and you are sending the right signals. Without this, this goes on and on. I have had founders who have not taken feedback, just been meeting investors, I won't name. They've been there for 12 plus months and they're good products, but they're not prepared to raise capital and they just don't put in the efforts or they don't put in the right effort. They're putting efforts, but in the wrong direction. Okay. Now, given that you've seen it take 6 months to raise, you need to start raising immediately if you know that you will run out of cash in the next 12 months. Anything beyond that, let's say you just have 10 months of money left in the company, that's big red flag, right? So keep this timeline in mind. Any question on this part?
I think it's all good for now.
Okay, let's keep going. All right. So this is what you need in your investor kit. Okay. You need a list of target investors. So who are the ideal investor profile investors you can reach out to? You need an army of ambassadors. These are people who can make introduction to the investors in their network or who can introduce you to the investors you have shortlisted, right? Third, when you reach out to the investors, what's the teaser or a short email that you send to them so you get a quick response? Or if you request somebody from your army to make introductions, what's the forwardable blurb you send to them? Fourth, what type of questions to expect from investors and how to prepare or answer them. This in itself, this just the first four topics. It's a 2 hour session in itself, which I cover in Investment Readiness Program session 5, right? So just telling you that this in itself is very detailed and nuanced, but you got to prepare on this, right? The other thing you got to prepare on is your pitch deck. Pitch deck is just not a PPT. It's two. It's your short format and long format. It's also the verbal pitch script, which means in a 5 minute demo day and 15-minute pitch, what do you say and practicing it as well. So we cover this in another session as well, but this is something you got to prepare as part of your investor kit. 7, you need to know your dynamics. So let's go back. this part. You need to know how much money you need to raise, how long will the money last, what valuation you can ask for, and how much would it dilute you. You need to understand the linkage between the four, right? This in itself is a big 2 to 2.5 hour session where we go deep into numbers. We understand the mathematics behind this and how to apply it to your respective companies. Eighth, you need to prepare your model, right? You need to think, like I was giving example to Jerome, how are you going to achieve certain revenue in certain time frame, right? So think of it this way. Let's say you want to achieve 2 million revenue in 2026 and your average contract value is 100K from your customer. So you need 20 paying clients, 20 into 100K. Very simple. Right? Now, to acquire 20 paying clients, you know your lead to sales conversion ratio is, let's say, 1%. That means you need 2,000 leads. And the cost per lead is $100. So that's your marketing spend. Now, you know your sales cycle is 6 months. So if you want to have 20 paying clients, you also need to probably do 200 demos, because from leads, there are demos and then paying customers. So how will you do 200 demos in the first 6 months, right? That translates to 30 demos in a month. That's one per day. So what's the team hiring plan to do this? What's the team hiring plan to service 20 paying customers? What's the product team hiring plan? What's the R&D team hiring plan? All that expenses you need to map out in your model and then see what's the negative cash flow, which will help you decide how much money you need to raise, right? So this is the exercise. Most founders don't do it. They simply download a template or see a template, punch in some numbers and be happy. No, you have to rationally do it the way I just explained, right? So this in itself is a longer discussion, but you need to prepare this before you reach out to investors. Nine, you need to know what investment instrument you want to sign. So you reach out to an investor, they're like, okay, so what terms are you raising at? Are you doing a safe convertible or are you flexible? That's okay. But at least you got to know as a founder, what are the different investment agreements? What are the key terms associated with each agreement and how to tackle that? And what terms not to agree. Okay. So this is something which I cover in multiple different sessions. There are 6 different sessions, but I will try to give you a bit of a quick snippet on each as much as possible. And then of course you need a structured data room. Any questions? Any questions on this slide?
All
Very
good,
simple.
Gaurav.
Okay, perfect. Let's keep going. All right. So the first thing you need is an investor CRM template, then making a list of your advisor army, right? And then matching your, let's say you make a list of 200 investors. You need to match the advisor army to these investors and be like, hey, could you make the introductions, right? And then you have to build a strategy of how will you reach out to 200 investors in 90 days. And then you got to prepare on what are the key questions that investors ask and why, right? Of course, there's a separate session on this, but this is something you got to keep in mind on this aspect of your investor kit, right? I'm going to show you an investor CRM template as well. We'll have this will be shared with you, so you already have access, so not a problem. But I just want to give you an example here. So if you see here, so scroll up to okay. So you have the investor name here, you have the title, what type of investments do they do? Priority, extremely important. So out of 200 investors, which one do you reach out to first, right? Which company? What's their LinkedIn? What's the status? Have you contacted them? Status, first meeting, second meeting, due diligence, what's the stage of interaction, right? What are the next steps? So it could be next steps here or feedback here. This is just a way of how you track your customer data. Similarly, this is an example of how you track your investor outreach process. Unless you do this tracking, it becomes super difficult to manage 200 investor outreach. So that was one example. Investor Q&A. So we'll be also sharing there tons and tons of questions investors ask. This is a list prepared by another fund, so they've done a good job. So don't want to reinvent it. We'll share that with you, but you got to prepare on these, right, for your respective companies. You'll have questions around your team, the problem you're solving, the product you're building, the market dynamics, your unit economics and go-to-market strategy, competition, traction, fundraising plans. So there are different questions under each of these buckets which you got to prepare on. So we're not going to discuss all the questions in this session, but we'll share this with you. But this is what you got to prepare on. Now you're like, Gaurav, where do I find investors? There are tons of these databases you can subscribe to. I also have a lot of them reach out to me for affiliations. So I do get affiliated as well, but I'm not promoting anyone here. You can choose anyone. You can also ask me if you would like some feedback on each. But these are lots of databases which have mostly updated investors where you can even filter by state, sector, geography, and whatnot, and populate your investor CRM. Okay. Any question on this particular slide? Okay, I'll keep going. This is an example of one of the founders I'm supporting, where we built out a 90-day plan to reach out to 200 investors with the objective of getting 30 investor meetings, right? So how does it work? First, scan investors is that first step I taught you, which is the ideal investor profile screening, where I check what's the stage of the business of the startup, what's in that graph, should I reach out to angels, VCs, or whatnot, and then I check whether do these investors invest in Canada. For example, the one I'm working with is in a different geography in the US. So do they invest in US? Do they invest in sector, the stage, and whatnot? From that 500, I shortlisted 200 quality investors and I did the outreach to them, right? So I plan it in this way. Week one, I did the execution planning, that timeline chart I showed you. Then week 2 and 3, I reach out to 100 investors, right? Or by week 3, I reach out to 40, next 40. And then I hope I get 10 investor meetings out of this. And I continue the process. The key part here is planning it. If you think of it this way, 200 investors in 90 days seems a lot. But if you break it down, it comes to 5 investors a day, which is not much, right? So this is a very good example of your investor outreach funnel and the steps involved and how you want to do. Of course, I go much deeper into this, but just wanted to give you an example of how to think about it. Then questions. You will have tons of questions. I wanted to give you one example. For example, if they ask you, how much are you looking to raise? Right? So your answer, I say avoid pre-seed, seed, bridge. You don't even have to label yourself to the investors. Okay. And do not just show me a pie chart. 20% goes to marketing, 30%. I need the pie chart, but not just the pie chart. Do not say you'll be out of cash tomorrow. If you say this, the moment I know that, I will not invest. That means you already late in the fundraising game. Do not oversell current commitments. So founders say, oh, we are raising this much, we are in advanced talks and we'll close the round tomorrow, right? Unless you really have a signed term sheet, please do not do that. I'm also teaching you how not to answer questions, right? And there are so many questions and so many ways of not answering it. I'm just giving you one example here. And do not get stuck on a valuation number unless you have a signed term sheet. So the best way to answer is these example statements. So I'm raising 1.2 million equity capital for a 2-year runway to acquire 10 clients with 1.5 million ARR. We will augment this with non-dilutive match funding of up to 500K, which extends the runway by 10 months. We already, again, if you have, that's okay. If not, that's fine. We already have a lead investor with 500K commitment, and we're looking to close the round. We'll use the money to onboard this, and you show a pie chart. You show that, but I've already articulated a quantifiable target KPI. That's important. Okay, so this is just one example of how to prepare for investor Q&A and different ways of how not to answer a question. Okay. Any question on this slide?
All good.
Okay, let's keep going. All right. So the next thing you need when you want to reach out to an investor or you want to request an introduction is a forwardable blurb or a teaser. The objective of this is not to get the money, but to get a meeting from the investor. Remember our screening funnel? This is the first step. So the objective is to get that longer 60-minute. Okay. So when you send me, for example, in a day, I probably receive 5 to 6 LinkedIn messages and I just do not get to see all of them. Some of them are so long that I have to keep scrolling, and I just leave them there, right? So when you do the initial outreach, if you're going to send me a thesis, right, or a PhD level report, I'm not going to look at it. Okay. What I need is in 2 to 3 minutes, can you communicate the key points associated with your company, which will excite me enough to give you that 60-minute call? That's the objective, right? So you have to ensure minimum text and a call to action in your email, teaser, or LinkedIn message, whatever medium you're using. So how do you do that? Hi, Gaurav. My name is so-and-so. I'm the founder. Give a two-liner of your company. No thesis, just a two-liner of what you do, for which stakeholder, what problem you're solving. Then put these bullets. These are the key buckets I showed you in the first slide on what investor is looking for. These are exactly those, the key ones. Show me one-liner or two-liner here. No paragraphs. Maybe just two-line statement or two bullets each. That's it. They should be so crisp and hard-hitting from an investor lens in minimum text that I like them. And then the call to action at my end is I'm going to click on the pitch deck link that you have. So send a hyperlink here. I click on it. Your deck should be so crisp that I love it in 10 slides. And the next call to action is you put your calendar link here. If I like all of this, I will myself book a time because it's my job to make investments and I want to invest in the right founders, right? It's not that you need the money. I also need you, provided there is a fit, right? What founders do here, they say, are you available next week? Question mark, and they break the chain. Now you're expecting me to check my calendar, figure out times and send that to you. You're creating friction. Avoid the friction. Put your calendar link. If I like it, I will immediately book a time. Okay, so this is a very important step. I want to also show an example here. So I'll make it a little bigger for you. We'll share this with you. For example, hi so-and-so, I'm founder, two-liner. This is still big. Just put two-liner. Put 1 to 2 lines on product, market, team, traction, financing. Put your hyperlink here. Put your calendar link here. That's it. Very simple. See how simple this is. I can navigate it in 2 minutes. That's how your outreach should be. Okay, let's go back. The other part you got to work on is your structured data room, right? So how you do it? First is you create a master list of all the folders and documents that you want to share. So let's go here. And these guys do an amazing job. So kudos to them. No need to reinvent the wheel. So if you look at this template, again, we'll share this with you. One, overview. Overview is the folder name. And these are the files within the folder, right? And you create this Excel, and let's say you've put your files or folder in a Dropbox or Google Drive or SharePoint in Microsoft. You put the location of the file here, the hyperlink here, and you share this with me. So I will click here, it takes me to the file. That's the smart way of having a very neat and clean master checklist. So this shows you that what documents is in an investor looking for under financial, corporate documents, financing documents, human resources, product, sales, customer. These are the different folders that you can have. We're not discussing all the folders. The idea is for you to take this back and see what all applies to your company. If something doesn't apply, don't bother about it. You can remove it. But if something applies and you don't have it, at least tells you what you need to work on. But this is the first starting point of a data room. The other thing to keep in mind, please do not ask for an NDA when you send me a deck. Nobody is going to do that. We receive so many decks, we can't keep doing NDAs. When you want to share data room, if you really have something very, very secretive, yes, you can ask for an NDA. But sometimes a better strategy is to have two data rooms. One, a non-NDA data room where you have basic information. And then if the investor has spent considerable time, they are interested, you can also be like, hey, we also have a NDA-based data room, which has much more details. Investors are generally okay with that, provided they're really interested. Okay, and these are all the folder types I already showed you. Certain documents should not be in a PDF format. You should show them in an Excel format. For example, your financials, your traction, your pipeline metrics, sales funnel metrics, cap table, because it allows us to understand the flow of numbers. Right? In a PDF, we can't see the formulas. We don't know where the numbers are, how are they calculated. Okay, and never overwrite. So if you change any documents, please don't overwrite the previous version. Always create a new version. You never know when you need the older documents again. Okay, so this is on your structured data room. All of us are aware about pitch decks. I think I took a session, I forget, maybe last week, right, on pitch decks, where you need to have a pitch deck, nothing else about it, but there are different ways to look at it, right? So depending on the stage of interaction with the investor in that funnel and how much time you have, you use different formats of pitch decks. Okay, sometimes when you're presenting live, you will have a deck which doesn't have too much text but just images. It works, but if you send that same deck to me in an email, I don't even know what to do with the images if there is no verbal relation or text explaining that slide. So keep that in mind. There is a difference between a leave behind deck and a deck you are presenting. It could be the same, but the one which doesn't have any text, you can't send me in an email. So keep that in mind. Now, the other way to look at it is how much time do you have to present, right? Do you have a 5-minute demo day or a 10-minute? So if you have a 5-minute, then you got to keep it less than 10 slides so that you present, but I also get to ask questions. If, of course, you have a 1-hour meeting, it's a separate thing, right? And you already know the different slides which go in a deck, so we're not getting into those, but this is something you need to prepare and different formats. And you also need to prepare the script, means what are you going to talk about in this slide in the 20 seconds you have on this slide out of the 3 minutes. Very important. Founders don't. So the founders whom I've worked with and they've successfully raised capital, the best way it has worked, type your script. Slide 1, these are the 2 points I'm going to talk about when I present. And you practice that, right? That's how you time yourself. Okay, so that's about the verbal pitch. Elevator pitch is how do you articulate in a minute, what do you do? You have to practice that as well. Okay, so the other thing you need is your pitch deck. Coming to financial model, extremely important. Remember, I am not looking at your modeling skills. I'm not looking at how accurate you are in your financial modeling aspects. No, I'm looking at the rationale of how you are thinking about your business plan. Remember, a financial model is how you will execute your business plan in the real world, right? So what I'm looking for is, do you have rational and practical feasible assumptions? So for example, if you're saying I'm gonna build a digital mental health care app and I will have 50 million revenue in 2 years. I'm like, how? Average customer will pay $100, 50 million divided by $100. That's crazy number of customers. How do you get those in 24 months? It doesn't add up, right? So it has to match, like it has to be rational, right? Then I'm looking at the first 24 months in terms of your cash flows. And I'm also looking at a broader picture on how do you think your business will pan out in the next 3 to 5 years, right? I'm looking at your month-on-month growth, your team hiring plan, profit and loss, cash flow. Balance sheet, I'm not really looking for, but it's a good check that you don't have a negative cash flow at the end, right? And then I'm looking at what capital do you need today and after 2 years and maybe down the line, right? And what are the corresponding business metrics? For example, for a digital mental health care app, it would be number of therapists, number of patients, number of sessions per therapist, number of sessions per patients, average revenue per patient, whatnot, right? It could be different KPIs that you want to talk about specific to your company. By the way, I, as an investor, I know that whatever you project, reality would be far from projections because things change. But remember, I'm not looking for how accurate you will be. I'm looking whether you have rational assumptions. Are you going in the direction of giving me to, or aiming to give me that 50x to 100x return? And when you do that, please avoid complexity. You don't have to make, sometimes I've seen founders pay $7,000 just to get a complex model made for a startup. You don't need that. I also build models. I also charge founders, but I charge for the rationale, not for a template. Templates are free. You can get them in the market, right? What you need is the thought process. Remember, a model is your numbers narrative in your pitching part. Okay. What goes into the numbers? How do you make money? What's your business model? What's your sales funnel metrics? How much does it cost to acquire and service customers? What are your key business KPIs? These sound theoretical, but if you look at it, making money is what is your revenue line, pricing, average contract value, and number of clients. So I already gave you an example, right? That's your average contract value is 100K. It's a SaaS subscription, right? So that's your pricing revenue model. And to acquire 2 million in revenue, you need 20 paying clients. That's your number of clients. So when somebody asks you, how will you make money? This is what they're looking for. And this is how you translate it into your revenue model. What's your business model? It's a B2B, B2C, B2G. What is your go-to market? What's your sales cycle, right? What's your sales conversion ratio? We already discussed this. I gave you that example of 2%, right? Or 1% conversion. What's the team hiring plan to execute all of this? That goes into your team hiring, right? Your sales conversion ratio, cost of acquisition, marketing, it all goes into your operational expenses. All of this are these sheets in your financial model, which now flow into the P&L, cash flow, balance sheet, and then you show the business metrics. It's a very logical flow. It's not just about numbers. This is your business plan, right? And this defines how much funding ask you need to have. How long will that money last? What valuation you can expect and what, right? So these are all interlinked aspects that you got to prepare. Just again, taking a quick example. For example, targeting 2 million in 1 year. I'm targeting small, medium businesses. It's a subscription with 10,000 per annum. It implies I need 20 paying clients, right? If my sales cycle is 6 months, then I need to target 2,000 leads with 1% conversion ratio in 6 months. Why six? Because if it's a 6 month sales cycle, then to acquire 20 by the end of December, I have to do it in the first 6 months. So timing is also important of where the expense will happen in what month. Then the ad spend, team mining spend, and whatnot. This is again just an example of how you got to think about your business plan in the form of numbers. Sorry, any questions?
There's no questions in the chat, but I can start asking you some of the older questions if you want, or we can wait
Oh,
till
of
the end.
course. Yeah, no, let's take up some questions.
Okay, perfect. Yeah, let's do that. So Claire asked if there's an upper limit to funds we can get from angel funding.
What's the what ones?
Is there an upper limit to funds that we can
No,
get from angel funding?
no, it depends on how much money they have. You
Okay,
can, by the way, so we're not covering in this session. You can take as low as $1,000 from one angel, put 50 angels in a special purpose vehicle as one entity, and now you got 50K. And on your cap table, it will just be one line item.
interesting.
That's a very interesting concept of raising money. I cover that in my other sessions on investor outreach, where I show them that how you can have 20 investors cutting 5K, 10K, 50K, 20K checks, where five of them were your close people, friends who gave $1,000, and they made introductions, and how it became like a multi-level marketing scheme now, not the right word, but how you can accumulate funds. And it's not like 25 people come on your cap table, it's one line item because you put all of them in an SPV called special purpose.
Got it. Thank you. And Lisa was asking, why wouldn't investors invest in a lower risk company with a smaller ROI? I think this was a follow-up to what you mentioned about how VCs go into businesses knowing that there's risk involved in this. So she was just asking, why wouldn't they invest in a lower risk company?
They would invest in a lower risk company. Oh, with a smaller ROI?
Yes, with a smaller ROI.
Oh, yeah. Because remember, they have to return money at the end of that 10-year lifespan, right? I showed you that math, right? 12% 10-year implies 3x. If
Yes.
I block my money for certain period of time for a lower return, I have zero probability of making 100x because my money is locked in. So I for sure know I will never reach that 3x or 300 million or that 100 million.
Got it.
All right. So the next thing you need to know about, so we discussed financial model. You need to know your numbers, your projections. You need to show me how with these projections you aim for a 50 million to 100 million company in the next 5 to 10 years. That's the vision I'm looking for. Okay, so you got to prepare this. Next, for your current funding round, you need to know how much money you want to raise. So you need to know these terms. They will ask you, how long will the company stay afloat without raising more money? That's your current runway. They'll ask you, how much money are you raising? That's funding ask. They'll ask you, with what you're raising, how long will that money last you? That's projected runway. Valuation, you all know. So then cap table dilution, right? So do you even know what dilution means, how it works? With this funding ask, what business KPIs will you achieve? So let's go back to my here. With this funding ask, I will achieve this business KPI. That's what they want to know because they want to know with this KPI that you will achieve after 24 months, will it allow you to raise the next funding round? Right? So there's always a linkage to what will happen next. So you got to be aware of these things. Okay, now let's get back to our example. And then what instrument are you looking to raise on? Is it a safe agreement? Is it a convertible note or a priced equity? Okay. Again, this is a full-fledged session, but I'm just going to cover some snippets for you. Let's say your net monthly burn, which is expense minus revenue minus grants, is 50K. Okay. Now you know that you should raise for at least 2 years of runway. There's a science behind it. Let's just assume that for now. So you for 50K for 24 months, you will need 1.2 million if I got my math correct. Yes. Right. So now you know that as per your financial model, your net monthly burn for the next 2 years on an average is 50K. So for 2 year runway, you need 1.2 million. So this is your funding ask. Now you negotiate in the market and then an angel says, I will give you a pre-money valuation of 4.8 million. You need to understand these terms. Pre-money valuation means your valuation today before taking the money from that investor. So pre-money. So what does post-money become? After taking the money. So post-money valuation is capital raised plus pre-money. Very simple. So 1.2 plus 4.8, 6 billion. Very simple mathematics, nothing complex. What is dilution? Dilution is how much equity the founder lost in this round to get this money. Dilution is calculated as capital raise divided by post-money valuation, 20%. 1.2 divided by 6, 20%. That's correct, right? So you need to know these terms, and I'm giving you just an example of these terms. Okay. What do you need to keep in mind? In any fundraising round, do not dilute more than 20% because we as investors look for certain equity ownership that founders should have at different stages. We are not covering those at what you need to have at what stages, but a rule of thumb which you can keep in mind, do not dilute more than 20% in any given funding round. Okay. Another key check, with this money that you're raising, which should last you for at least 2 years, will you be able to achieve certain business metrics which will position you strongly for the next funding round after 2 years, which I already explained you from the previous slide. So these are the two tricky things you gotta keep in mind while deciding how much to raise, at what valuation, and what terms. Okay. Last thing that you got to keep in mind are legal aspects. Extremely, extremely important, right? Uh, Now, of course, we can't cover all the topics here, right? Oops, sorry. Go back. But whenever you are closing a round, and Cynthia, you would have come across these terms if you did a safe agreement, right? You need to know of these terms, right? Post-money versus pre-money valuation, dilution, liquidation preference. Very, very difficult term. Difficult means dangerous term you should not agree to, and I'll show you the checks. Board composition. Are you giving away an observer role or a seat? You should not give away control. Anti-dilution. What type of anti-dilution clause? MFN clause, most favored nation. Very dangerous clause. So whenever you come across a term sheet, avoid this clause. It means whatever terms you give me today, and if I have a MFN clause as an investor, let's say after 3 years you gave some better terms to another investor, I automatically get them. Most favored. Okay. Dividends. Are you giving away dividends? Founder vesting. So your shares need to be vested in your company when investors come in. Pro rata rights. So investors will have certain rights to invest again in future rounds. Then there are more. I mean, we're not covering all, but you got to understand these terms before you sign them. Okay. And there are more clauses in a term sheet or in a safe agreement or a convertible note. I have listed the ones which you should definitely be aware of. And if you're doing a safe agreement, you need to understand the concepts of a valuation cap, percentage discount, capital. These are quantitative terms which dilute you as a founder, right? And I take a full session on explaining with actual examples. Can't do all of that here today, but your key learning as a preparation of your investor kit when you talk to investors is know what instrument you want to use, whether it's a safe agreement, convertible note, or a priced equity round. And in each of them, you will come across different terms. You should be aware of these terms. The key thing to be cognizant of: avoid a MFN clause, liquidation preference. The moment you see this clause in a term sheet, as long as it says 1x non-participating, that's the definition, it's okay. Anything other than this, 1.5, 2x, 3x, you simply do not sign that. If it says participating, let's say non is not there, it just says 1x participating, do not sign it. Not good for it. Okay? I can't explain why in this session. There's a full mathematical calculation around it. I do cover it in one of the longer sessions, but this is just a 2-hour session. This I cover in 12 hours of coaching sessions. But I just want you to have the key takeaway, right? Board control. Ensure the board number is set in such a way that whoever has the right to vote, US founders have a majority, at least once for Series A. After Series B, it's very difficult. You always most likely end up giving control because of increased number of investors, but just avoid that before Series B. Anti-dilution. You will see this clause in your term sheet. There will be two types: full ratio, and there will be another called weighted ratio. Okay. For you, weighted ratio is better. That's the key learning. So avoid full ratio. Again, there's a full mathematical calculation. Why I'm sharing these things with you, no lawyer will teach you this. I've worked with so many founders. They have lost equity by signing terms without knowing it. And me being a fund manager, I know because I've worked in so many legal jurisdictions on term sheets, how these impact founders negatively, right? So I'm bringing it with me lots of years of experience and term sheet experience in telling you what not to do. Okay, so just wanted to cover that. Just to recap, we covered everything in the investor kit, right? And of course, there are deep dive sessions on each of these topics, but I tried to cover at least a snippet on what you need to prepare before you reach out to investors. For you, the homework would be to answer these questions, right? And if I go here, oh, sorry, I will. So this is one of the ecosystems I mentor in Mexico. Sorry, that's the name, but I'll share another link with you. But here you can map out your investor kit. You can map out all the questions that we just discussed, um, right, and whatnot, right? So I will share that with you, and you can do your own self check. Okay, so that's pretty much it. We covered the full session on this topic. Now, just to tell you, this was what we covered today, right? But there are more aspects on fundraising dynamics, which is IRP2. I talked briefly about it: funding ask, valuation, runway dilution, target KPIs. I talked about financial modeling. So how do you think about financial models and show that you can make a 50x to 100x return to investors? Then we talked about pitch. So which format to share, why storytelling important, how to build a pitch, and I covered lots of examples of what to do and what not to do. Then I gave you a snippet of one questions. I covered 10 or different questions in this session, and I also show how different you can use different strategies of rolling saves, SPVs, and how to reach out to 200 investors in 90 days. And then, of course, term sheets. I go very deep into each clause and how it works and how it can be a big challenge for you. Okay. And this is how you can track your progress. All right. We come to the end of the session. Any questions?
Thank you so much, Gaurav. I think on behalf of all of us, this was such an amazing and insightful session, and all of us got to take away so much from here.
Thank
I
you.
personally got to learn so much as well. This has been really helpful for so many people. I will go into questions as well. There were a few that from before. So Lisa says, "What are your thoughts on investors that reach out to me on LinkedIn? Did we already pass through parts of the funnel? I never know if some of them are scams."
Oh, just validate them. You will probably have. So first of all, scams are real. So yes, be cognizant. Okay. Second, validate them. You will have common connects. Just talk to them. I always do that. I always recommend founders to do that. That's perfectly fine. Sometimes, for example, I am not investing. So my LinkedIn is very clearly saying I am not investing, but I do support founders on fundraise. So when a founder reaches out to me, hey, I'm looking to raise capital, the first thing I tell them is, hey, I am currently not investing. However, I do assist on your fundraising. So I'm very crystal clear. So you have to ask whether that person is giving you services or are they investing. And then, of course, you validate with your network.
Got it. Perfect. And Jerome will come to you just after these questions, but Gaurav, Annie says, what contains in the due diligence process or stage? Is it like auditing the financial statements?
So typically, financial statement is probably 5% of the work in due diligence, right? Because we are looking at, do you remember the first slide, what we are looking for? We go deeper into that. So we evaluate your resumes, employment contracts, we evaluate your technical architecture, product features, product demo, technical due diligence is there. We do customer interviews, we look at your customer contracts, right? We look at your partnership agreements. We look at any kind of IP regulatory claims. We evaluate your numbers also. So there's a lot of things. It's like founder due diligence, technical due diligence, business due diligence, legal due diligence. So corporate structure. Is the website owned by you personally or by the company, right? Is it owned by your Gmail or your professional account? Small things. So it's a lot of that due diligence buckets with what we look at.
Wow. Basically everything in a
Correct.
lot of detail.
Because it's money, right? We're giving
Yeah,
money,
that
so
makes
we
sense.
have to. Yeah.
Yeah. And do you consider government grant funding as a form of traction?
Yes and no, depends on the stage. So if if you already have revenue and you have clients, then you don't need to show it in traction. You show it in your funding ask slide, which is, hey, we have been successful. But if you don't have anything in traction, yes, you can show that.
Got it. Okay, perfect. And before we come back to this, Jerome, do you want to unmute and ask your question?
Well, can you hear me?
Yes.
Awesome, awesome. Yeah, I was gonna say this has actually been really helpful and kind of exciting at the same time. Um, I have two questions. The first one would be in Canada, right? Like, because I previously raised some funds for a different startup a couple of years ago. What would you say the climate right is for fundraising at the pre-seed stage? Because I know that if you're a pre-seed stage startup in Canada and you have like even just like a prototype slash MVP, it's very hard to have conversations with Canadian investors.
Yeah.
So what would you say about that?
This is my personal approach in life, whether it's for personal as for professional. I never get bogged down by obstacles.
Mhm.
Right? So there are plenty of investments still happening. You just need to prepare and find the right investor. There are plenty of angels who are still investing in Canada at that stage, right? You just have to stand out.
Mhm.
Second, there are also investors globally who invest in Canada. You have to find them and reach out to them. So you remember that step I showed you where you start with 500 investors and then you filter them.
Yeah.
That filtering per investor takes 10 to 15 minutes because you got to check their website, check their portfolio, check on their portfolio page, have they invested outside US in Canada or not, and whatnot. Or check for Canadian companies who have raised from investors in the US in the Canadian headquarters.
Mhm.
So there's lots of that, I would say, grunt work, Jerome, that we need to do as part of fundraising and just keep going, right? Of course, if you get some feedback from an investor, which is like, hey, this is a Me Too product or very easy to replicate, or there is no USP, right? Or your team does not have the right skills to execute this particular segment or industry, or this does not seem like a solid return opportunity, then you got to take that feedback and first work on it instead of continuing to pitch, right? So, of course, funding cycles change. It's not as easy to get money as it was 3 or 4 years ago or the 2020, 2021 time period. But I would still say there's plenty of founders who are able to raise money today. Just got to prepare.
Okay. Thank you for that. I think that it's good to hear from you too, because like I'm noticing the same thing because I raised outside of Canada and all my friends are just telling me the same thing. They're like, just leave. But
Yeah, absolutely. Just get the money. Doesn't matter where it's coming from as long as it's a legitimate source. So that's
yeah. And then the second one was, what's the best way to stay in contact with you? Just LinkedIn or?
Yes, so I do want to address that. Yes, you can connect with me on LinkedIn, and I'm a very humble human being, but I apologize if I can't answer your messages on LinkedIn because I I receive floods and flooding of messages every day, and I'm just not able to keep up pace with it.
Mhm.
If you want to book some time with me, I operate in two modes. One is I work, let's say, as a mentor with Yspace and others, whatnot. So if you are a startup there, through your program manager, they can allow you to book a session with me. If you want to reach out directly to me to book a time with me, that's paid hours separate. So
Mhm.
that's the answer to your question.
Okay. Thank you so much.
Okay.
Perfect. Thank you so much, Jerome. One more question, Gaurav, is what are your thoughts on impact investors? We were told to pursue investing as opposed to traditional VC, but we found them even harder to get money because they look for financial ROI and potential impact in their portfolio.
Okay, yeah, but why do you want to reach out to? So here's the thing, I'm a climate advisor in 3 countries, so pretty well aware of that space and what investors look for, right? And there are two types of investors. One who only look for business returns as long as you are building something in the climate space. And then there are others who look for both business returns and an impact metric associated, right? So that's the first thing. Now, my question to whoever asked that question was, why do you want to reach out to impact if you're not an impact startup? That's not the right advice you got.
Lisa, do you want to clarify?
Yeah, for sure. We are an impact startup, or we were
Okay.
until I stopped pitching. Um, we were in the clean and ocean tech space.
Mhm.
And the reason why we were told to pursue impact is because some of them request for a smaller ROI in lieu of impact.
Okay, that's a fair proposition. So, I mean, there are tons of investors in that space. So, what's the like, are you facing challenges in finding them?
Can do that.
Yes and no. It's just like instead of just meeting one criteria, which is the financial ROI, which is the 100x,
Mhm.
we are now facing two criteria. Is we need to meet the impact that they are
Yeah,
looking for, and I need to meet the
yeah,
financial ROI, which is even harder to adjust.
yeah. So there are two things you need to do as a climate startup, right? First, or the three things you got to show in your business. First is the technology readiness level. So TRL, what stage you are at, and how quickly can you reach stage 8 and above, or 7, 8 stages. That's one. Second, you got to show me a techno-economic analysis, right? Which is if your climate metrics go into this business model, cost metrics go into this model, is it even a feasible project in the first place? For example, if it costs more to build this innovative product as against what a customer could possibly pay for it, then it's not viable, right? So what's that uh, project feasibility and payback period? And the third thing you have to do is a life cycle assessment, right? The LCA analysis. That's standard for any climate startup to do before talking to impact investors. So I'm not sure if you've done those three steps. If you've done those three, then LCA automatically gives you all the ESG metrics and tracking parameters, which you could then spin and show, hey, this is the impact I'm creating in the ecosystem. Does that answer your question, Lisa?
Yeah, yeah, it does. Thank you.
Perfect. Thank you, Lisa. And we have three questions, and then just in the interest of time, we're just going to take these three questions and then Blondin, and I will try to wrap it up. But Eleanor says, I'm curious about location. I'm in a rural place, and a lot of opportunities, including York, require physical presence in residencies or partnerships. Do you think this is a really big issue, or does it come into play often when a prospect is a good one?
So issue from whose perspective, the founder perspective or investor perspective?
Again, Eleanor, do you want to clarify?
Hi, yeah, thanks for that. Sorry, I'll give you that clarification. The thing that I've run into is I find that a lot of the time when I'm looking at various, say, like incubator programs, things like that, there's an obligation to like be in the space 2 days a week or something of that kind. So that's really what I'm getting at is, and just from the perspective that, 20% of the population in Canada, it's on 98% of the land mass that isn't in
No,
cities.
no,
So
of
I'm just
course.
curious about that.
So
Yeah.
no, absolutely.
Thank you.
That's not the case. I'm partnered with like I think 8 of incubators here in Canada professionally. So I haven't seen that challenge, right? So you're already at YSpace. I don't know if that's a prerequisite, but for example, YSpace also partners with Venture Lab, where I'm also an advisor. Venture Lab does not have any requirements for you to be physically present in the incubator. They're based in Markham. We have companies from all over Canada in that incubator. So there are lots. There is Communitech in Kitchener, right? They also do not have such a requirement that you have to be in Kitchener. So Eleanor, no, absolutely not. There are lots of, I would say, regional innovation centers or RICs that you can search for who do not have this requirement, and you can partner with those. Even Yspace can make introductions because we all we work collaboratively. Does that answer your question?
Yeah, it does. And I think maybe it is really specific to my situation because the venture acceleration opportunities where I live are actually very small. So, but I appreciate that very much. That was great. Thank you.
Yeah, check for RICs in Canada, RICs in Canada, Regional Innovation Centers. There's 17 of them in Ontario, at least I know, right? Which you can reach out to.
Yeah, I'm in British Columbia, so it's a little different, but thank you.
Even BC companies are accepted in.
Oh, amazing.
Yeah, that's what I'm trying to do. Like, for example, Venture Lab works with, I work with founders in BC, right? In BC, for example, I'm also an advisor with Foresight Canada. They're into climate. Right. So there are lots of these. My recommendation is search for incubation centers funded by the government in Canada. You will find tons of them, and all of them do not have this requirement.
Awesome. Thank you so much.
Welcome.
Thank you, Gaurav. And would you recommend taking a loan from banks to start a company or go directly to angel investors? And is it seen as a negative if you do?
First of all, you should pump your own money to start, right? Nobody's gonna seed that. So it will be your friends and family who are gonna help you to start that company. And then banks are very difficult to get money from unless you have a revenue or you can show purchase orders, right? So if you have POs, then yes, you can get a small business loan from BDC. There's so many programs and they will take a personal guarantee and probably give you somewhere at 10% interest rate. So you can do that. There is nothing negative about this or that. Whatever works for you, it's a form of capital. Remember, equity is the most expensive form of capital because you're giving away a chunk of your company which you're never going to get back, right? So that's how I would look at it. It's more about figuring out who's buying into your story. Is it the bank? Is it the angel investor? Or maybe it's a crowdfunding platform as well, right? So it depends on.
Okay, perfect. And Blondin, we're just going to wrap up with you. Final question, if you want to quickly unmute
I'm
and tell
I'm
us.
happy to stay back for a couple of minutes just in the interest. If
Thank you so much.
no
Really
problem.
appreciate that.
Sure, thank you, Basil. So I have a question. You mentioned is if your product or if your innovation is easy to copy. In my instance, I am targeting a first in market product. I would say not first in market because I'm looking at a different sector. Let's say from walking to running. Everyone is walking, but I'm trying to run. Is that going to be an issue or is that an issue?
I cannot answer that without evaluating the product, the business use case, and scalability and defensibility. So I wish I could answer that, but once I see something, then I can go deeper into it. Hey, is this defensible or not?
Exactly, because I wanted maybe if you don't mind, maximum 3 minutes. I know you're busy. I can chat with you after if you don't mind, but if
Trust me, I would love to, but you have to trust me. My calendar is like literally from morning 8 a.m. I've been continuously sitting.
okay.
I wish I could do that, and I want to do that. Trust me, but I just do not. I'm working 6 days a week. Trust
Mhm.
me on that.
Okay, so what about now? Because okay, I will just focus on the aspect which you mentioned. You mentioned if your idea is easy to copy. I don't think any idea it's not easy because once you publish it to the public, everyone can see and maybe correct one or two. What do you have as a feedback to that?
So, for example, I'm just going to take an example. You're making an app which allows, like I play badminton. You're making an app which allows us to book a badminton slot in Canada. That's something super easy. There's no defensibility there, right? But if you're building an app which allows a medical imaging software which allows quick scanning of X-rays, that is still copyable. It will take 1 year, but that's still defensible and you can scale fast. So that's what I mean in terms of copyable. Does that help?
Yeah. So that means at that stage, IP doesn't matter.
IP, unless it's commercializable, doesn't really matter.
Can you expand on that?
So for example, if you have a patent, but you can't show me a commercializable strategy around it
Okay.
and defend it in the investor due diligence and Q&A, then it won't. Like no investor will just pay you because you have a patent. Yeah.
Yeah, thank you.
Thank you so much, Gaurav. I think we'll wrap up. And in terms of the book recommendations, we'll make sure to get them to all of you via
Oh, is
email.
there a question on book? No books, trust me. Don't books. Books give you theory. Whatever you learn today is like years and years of experience, practical execution experience, all put into executionable steps. So unfortunately, books will just give you theory. They won't teach you execution of a fundraising process.
Thank you so much. That was the final question. And